Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. Welcome to this week's episode of the Prime Property Finance Podcast with myself, Gareth Morgan, and Mark Watts. This is all about buying your first investment property, and that can be a really exciting time, but it can also be a minefield. We've seen far too many investors rush in and focus on the property itself, completely overlook the financing, the tax, and the long-term planning. That results in stress tests that don't work, surprise stamp duty bills, and unexpected costs, and in some cases, the deal falling apart right before completion, and it can be very painful and very expensive. So you don't want to do that. It doesn't have to be that way. With the right planning and the smart financing and a clear strategy, your first investment can set you up for financial freedom, stable rental income, and the foundation of a growing portfolio. In this episode, we're going to share the 10 key things you need to consider before buying your first property investment to avoid the costly mistakes, start your journey as a confident, well-prepared investor. Let's dive straight in. Mark, welcome back. Another episode of the Prime Property Finance Podcast. How are you?
Yeah, very well. Very well. Yourself?
Yeah, good. Thank you. It was a busy week last week, a little bit on the road, getting out and about to a few different events, but good to be back in the office this week and really excited to bring this next episode.
Yeah, no, it's been a busy week. I think everybody's back from their summer holidays, back to life, as it were, and the phones certainly haven't stopped. So, yeah, good to come back to another episode. Plenty to talk about. Actually, a lot of the conversations we've had have fueled the topic of this week's episode. So, looking forward to it.
Yeah. So, do you want to just give some context as to why this episode talking about the things that people should consider before they buy their first property? Do you want to just give a bit of context as to why you think this is a really important topic?
Yeah, absolutely. So, as you know, we speak to a lot of people through varying degrees of experience, some very experienced large landlords, right through to the people who are really considering starting out. Seems to be we're having a lot of conversations at the moment with the lesser experienced landlord, in fact, the newbie, the person who's looking to get into it. And there's a lot to think about around this, and a lot when we end up talking to people that they haven't actually considered, so have to go away, put their thinking caps on, start to answer their own questions and so on. And we thought, yeah, this would be a great idea. Let's bring these topics into our podcast and hopefully get people thinking about some of these topics and hopefully be able to answer some of the questions and start their property journey on the right foot.
Absolutely. So let's dive straight into it then. So number one on our list is investment objectives and goals. Ultimately, why are you getting into property in the first place? Do you want to sort of share a little bit on that?
Yeah, definitely. So, we hear this, what's your why and that sort of stuff. I get it. But the main question that we would always have is, what is the overarching vision? What are you trying to achieve? It's hard to come to us and ask for directions if you don't know the destination. We can give you 4 rights, you'll end up back in the same spot. You'll just go around the block. So setting out your long-term objective and understanding what you're trying to achieve helps us to be able to navigate some of the conversation that we're having. So a couple of considerations are, are you investing because you want to be financially free, for example? And that's fine. But what does financially free mean to you? It's different for you as it is to someone else. Are you investing because actually, I've got a good job, I've got a pension, I've got some cash savings, and I see property as another string to my bow for future revenue in 20 years' time? That's a very different investment strategy and set of objectives that we need to understand and consider. So it's a very broad topic. It's emotive as well. So there is no right or wrong answer to it. I guess there's a bit of soul searching that needs to happen as to, yeah, you may have seen something online that's, or a friend who's got a few properties and you think that's a great idea. There's a lot more to it than that, which we'll come into. But understanding your why, what are you trying to achieve, is fundamentally, ground zero. And until we can understand that, it's kind of pointless moving forward.
Yeah, I like to quote Stephen Covey on this, where he said, start with the end in mind. And so really understanding where the destination is long term and how do we work backwards to get there. And so ultimately, most people are doing it for sort of financial freedom, as it's been coined. But there's probably 3 levels to financial freedom. The first is financial security, where you have enough cash flow coming in to cover your basic needs, your food and shelter and all your outgoings. Then there's financial security, which is probably your, the next level is financial security. Financial freedom is more where you've got your ideal lifestyle built in. So you're not just your main overheads, but you've got your holidays, you've got your perfect car and all of those. And then the top level then is more financial opulence, where you've got more money than you need, and it's just ridiculous because of the compound effects of really, really hammering it. And that's probably more generational wealth as well. So those are the kind of 3 levels. And then within that, the other thing I see often is people mentioning, I want 10 properties. Right. Why do you want 10 properties? Or I want to get $5,000 a month. And then when you start actually drilling that down with people, you say, well, why do you want 10 properties? I don't know. It's just a number that I've always thought of. Or I want $5,000 a month coming in, right? Is that $5,000 a month rent, or is that $5,000 a month profit? Is that cash flow? Because what people will say is, well, I want $5,000 a month cash flow. Well, $5,000 a month cash flow, rent, takeaway, mortgage is different to $5,000 a month rent net profit, because if it's in your personal name, there's a huge amount of taxation, plus there's other costs, void and maintenance, etc. So there's a saying that we kind of go through, is that nothing should be arbitrary, which means it shouldn't be a figure that's just been plucked out of the air, a number of properties, X number of properties, X number of units, X number of rental income. Everything should be worked out. So there's an exercise that you need to go through to work that backwards. So, right, this is the amount of income that I need. So I've done this exercise. I'm very clear on what my goals are and where I need to get to. I'm not there yet because I've got a certain level that I want to get to. Now, in order to do that, you have to go, right, this is what I need to get to. That's net of tax for starters. Then I've worked out all of the things that I want to be included with that. And then I got to work backwards and say, right, if this is my property strategy, this is this is the amount of properties that I need in that bracket to get there. So there's a lot of planning and a lot of consideration that needs to go in to the longer term, really. And so, the other thing is people invest for different reasons, right? So when I started investing, I was investing for long term. I was self-employed, I had no pension. And for me, it was about creating a pension pot for retirement. I was happy with the income I was earning from my job. And so it was all about the long term. So we were taking roughly 50% of our properties on repayment rather than interest only, because we wanted to try and pay off as much of that debt longer term, along with the inflationary increase in capital value that we would get in the long term. So we analyze all deals on cash flow, but with a view of looking at them on a long-term basis. But some people will have a different opinion. Maybe they're in a job that they hate and they want to get out of that as quickly as possible. And it's not necessarily that higher paying job. So for them, it's all about cash flow, and they want to maximizing cash flow so that they can give up their job and focus on property full time, or go and do something they love, or work for charity, or whatever it may be. There's so many different options. I guess the key thing is having clarity on what it is that you want and what your goals are.
Yeah. And I think, there's a few points there that I just wanted to add to is, we talk about the 10 property thing, again, it's an arbitrary number. We can't ego is in the equation as well. So, some people just see that as that means I'm a reasonable sized landlord. So, take your ego out of the equation. That can lead you down the wrong path quite quickly. And I think coming back and being quite formulaic about it, as to say, to get to your objective might actually only mean 5 of a certain type of property or what have you, and a certain type of leverage and those sorts of things. So, and also, there is a lot to think about, or just be careful not to over-engineer it as well, because your plans will change. Life does change. Your goal and your long-term vision might change when you're midway through the journey. I guess the point is have an aim, keep reviewing that. Don't try to overcomplicate things. Otherwise, you'll never get started. Analysis paralysis and all of that sort of stuff. But you do need a longer term plan. As I say, you cannot ask for directions if you don't know ultimately where you want to go. You could end up in an entirely different destination. But the point is, you need to start somewhere.
And absolutely, analysis paralysis stops so many people from doing anything. And then you've got the other side of the equation, which are the trailblazers who just go out and gung-ho and just buy, and don't really give any consideration. And then they create a problem for themselves further down the line, because they've got property in their personal names, they've got the properties in limited companies, they've got SA, they've got buy-to-let, they've got HMOs, and they're all over the country, and there's no consideration. So they've just created this monster, but they've taken a lot of action, and it's a better problem to have but not always. So it's somewhere in between is taking considered action. Correct. And having a plan and trying to stick to that. And like you said, things will change, the economy will change, rules and regulations will change. And so you have to move with the times. And one of the things about being a property investor is being able to move and be resilient and be able to kind of adapt and adopt the new strategies and techniques and that are happening in the market.
Most definitely, yeah. I agree. I think don't over-engineer it. Action outweighs overthinking, I think, every time. But considered action is definitely the way forward.
Awesome. So once then, maybe move on to step 2 then on our list. Once you've kind of figured out what your investment goals are, we investment objectives, we haven't really talked huge amounts about in the detailed investment objectives in terms of ROI and yields and things like that, because that's probably another topic on its own. But once you understand, right, here's where I want to go long term, then we need, if you come into us as a broker from a finance perspective, we need to kind of really understand your personal circumstances. So that there's 2 parts to the next few steps. The first one is the next few steps are around your personal circumstances, your setup, and your strategy. What type of property, what type of property strategy are you going to take? And then the second, so that's around you and your strategy. And then the second, there's another probably 4 steps then, which are more on the deal itself and how that looks on a deal analysis basis. So let's just talk about personal circumstances then. What are the kind of key considerations from a personal circumstance should someone consider before they buy their first investment property?
Yeah. Okay. So great point, and something that's overlooked by a lot of people. So typical scenario will be, sorry, Dave, but Dave down the pub. Yeah, we'll be having a conversation. He's got a couple of properties, and you're sitting at the end of the bar having a chat, and Dave has been able to do X, Y, and Z to get this property and whatever. Yeah. So he's been able to buy a block of 41 flats. He's done it with very little money in the deal, etc. He's got 100% funded, the usual stuff. It's probably true. He probably has done exactly what he's just said he's done, but his set of circumstances are entirely different to your set of circumstances who's getting that information off him. So it's extremely important that you consider your own personal set of circumstances, so that when you are trying to achieve these objectives, and you're thinking of your plan, your ability to get there is very much going to be defined where you currently are today. Yeah. So if you are somebody who's 18 years of age, okay, and we've got a client at the moment who's 18 years of age, he saved some cash living with his parents, and he's just investing in his first property. His set of circumstances are clearly very different to someone who's mid-40s, got a well-paid job, got a nest egg behind them and so on. So their actions are going to be quite different. So things to take into consideration are going to be, what access to resources do you have? Now, this could be your own personal savings. So you might have accrued money over time, which is what a lot of people do as they get through through the job ladder, as it were. They will accrue and earn more. You may have inherited some money, maybe. You may come from a background that, fortunately, you've got a wealthy family that can gift deposits and those sorts of things. So what is your access? Because you will need cash. Yeah. There are other strategies that don't need it, but we're focusing on property ownership. So property ownership means you will need cash, and you will need probably more than you think you need. So let's be realistic as to what is your access to capital involved in this. Other things to consider are going to be your personal creditworthiness. Okay, so if you've been through a difficult time, many people did through COVID, and through no fault of their own, couldn't pay certain bills and so on, but they will now have blips on their credit profile. What is your creditworthiness, and how long and how good or how bad is that? So absolutely get hold of your credit profile. Don't bury your head in the sand. Yeah, cool.
I often get told by people that because it's a buy-to-let, it's going to be assessed on the property and the rental income. So and it's owned by a company, so my creditworthiness doesn't matter, or my income. It's the company that owns it, not me.
Yeah, we hear that a lot. And there is an element of truth within that. So when you look at the property, there are two considerations. One is the property, and you're right, on a buy-to-let, your personal income and personal creditworthiness is less important than if you were to buy your own home. They go through that with a fine-tooth comb because your income is determining whether you can afford the mortgage. On a buy-to-let, it should wipe its own face, and there's a different set of affordability criteria which we'll come into. However, that's the property on a standalone basis. Now, we also look at the people who are borrowing the money. Yeah, even if it's a limited company, ultimately, you as the shareholder and director are the borrower. Yeah, so you're going to be making the financial decisions. Now, a lender's perspective on this is a leopard doesn't change its spots. If you've consistently made bad borrowing decisions and you've consistently missed payments, in all probability, it points towards that's an ongoing trend and you're not great at managing money. Yeah, so that is a consideration that the lender will take into the lending decision then on that. So the most important document that you can hold is your credit profile. I've got clients who have got 50, 60 properties where one of their tenants has missed a utility bill and it's shown as a default on their credit profile, and it causes them problems when you consider they are, wealthy and have good levels of income. So please protect that. If you don't know what yours looks like, get an Experian report and don't bury your head in the sand over it. Time is the best fix for your credit report, really.
And that should be part of your, your monthly admin really should be managing and reviewing your credit report to make sure there's nothing on there so that you can nip it in the bud if something comes up really early on. Because a lot of people will get letters, water bills, utility bills sent to a buy-to-let because that's the address of the property and that's where the bill goes. But the landlord will say, well, I've never been there. And so, if it's been sent to the address, I haven't been there, the letters will just keep going to that address. The landlord never sees them. And the next minute they get lumped to the CCJ and it causes problems. So that's obviously for someone who's already got property. But the reality is if you are looking to get your first property and you don't know what your credit what your credit report looks like, then that's one of your first actions that you need to take now is understand your report and see if there's any blips on there. Also, there are about 1 in 3 people have a mistake on their credit report where things have been misreported. So we talk about credit reports all the time till we're blue in the face, but that's how important they are.
Oh, absolutely. Yeah, you can get your credit report for free. You can download that, but just pay the £10 a month. They will email you on a monthly basis when something happens on your credit file. You can dive on it straight away. Yeah, I personally experienced an issue where I couldn't work out my credit score was so low. I was like, I've never missed a payment ever. When I took a look into it, everything on my profile was reported twice. I had 2 home mortgages, I had 2 credit cards available to me, and so on. So I had to ring them up, and they told me it was done manually, which I couldn't believe anyway. Separate story. They wiped all that off. Credit went back to where it should be. So it's super easy to keep an eye on that. Other things for consideration then in your personal circumstances, sort of alluded to a little bit, is, are you currently working? Are you in employment? What is your current lifestyle looking? Do you have disposable income within your income as it stands at the moment? We'll come on to this in more detail later, but investing in property is a longer term thing. And there will be unforeseen events that will require cash of some description. And what's your ability to afford to be able to do that? Or equally, what if you're literally just starting out? How much of your income can you afford to save, set aside to start this journey? Because they say through home ownership, property ownership, you will need some cash for it. And then the last one, I mean, there's many more, but these are the main ones. Do you own your own home? Now, it's not a showstopper at all. And we've got many clients who rent their own property, who subsequently invest in buy-to-let. However, lenders would prefer, or you would have more choice of lenders if you own your own home already. A few reasons for that. The main one, which stems back all the way to early days of credit scoring, is if you own your own home, you're easier to find. Yep, if something goes wrong, you're easier to find. You're less transient. If you're a renter, you can be gone from one address to the next and so on and so forth. So one of the things, it really helps your credit rating if you've got your own home that you own with a mortgage. You can't just disappear off the back of that. So again, it's not a showstopper, but just looking in your own set of personal circumstances and so on. And there is a whole debate over whether you should own your own home or not.
Yeah, and that's probably comes from the Americans a little bit, where there's a lot more rental demand, and so that kind of story about investing the money in your own home into assets rather than a liability, which what a lot of people would class their own home as. But like you said, that's a topic for a different day. So just on that, another reason being that lenders prefer it if you are a homeowner is that a homeowner, your own home has a residential mortgage on it, which has been assessed on your current credit and your income and your affordability. Buy-to-let mortgages are assessed on the rental income of the property and less on your income. And so if you already own your own home and you're making an active decision to go and buy a property, and it's probably of less value and makes more commercial sense in terms of the numbers as an investment, they'll see that that's a clear strategy that you're taking. If you don't own your own home because you can't afford a residential mortgage and you're trying to buy a property on a buy-to-let basis, which potentially could be seen as you trying to buy a residential property. So what they call it is a backdoor residential, where you try and buy a buy-to-let property on a buy-to-let basis effectively because you can't afford a residential, and then go and live in the property as your residential, which would be on different set of terms. So that's why, especially as a first-time buyer, first-time landlord, if you don't own your own home, they will assess it as if you are buying your own home, and could you afford your own home if you wanted one. So there are other considerations around the first-time buyer, first-time landlord, but that's one of the reasons why home ownership. So if you own your own home, you've got good income, you've got good savings, so that if you did buy a buy-to-let, that you've also got some surplus income. So if you can afford voids, you're a much, much more appealing client or borrower for a lender.
Yeah, absolutely. And I think it's worth noting as well, look, these on a standalone basis are rarely showstoppers. However, when you start going, right, I've got much of a deposit, I've got a few blips on my credit profile, my income isn't great, or I don't have an income in some instances, and I don't own my own home, you're asking a lot then of the lender to consider you as being credit worthy to have a mortgage, despite you having the best deal in the world and you can afford it and it washes it, it's perfect. As I say, that's one part of the equation, a big part, no less. But personally, then we need to tick some of these boxes first, and that gets overlooked a lot when people come to us for the first time. They're quite surprised by that.
We do have a bit of a laugh and a joke about it, but the reality is we speak to a number of ninjas, people who have no income, no jobs, and no assets. And whilst the reality is, in that exact moment in time where they're in that position, maybe they've just lost their job, so they've got no job and no income, and they just don't have any assets. It's quite easy to fix a lot of those. You can go out and get a job, so which would then get your income, or you might not want to get a job and no income, no job. However, someone might be prepared to work with you because they've got assets, and you could work together on some sort of joint venture, JV. So that it's not to say that it can't be done, but in that moment in time where you tick all of those boxes, it's going to be very, very difficult for you to do anything. But there are things that you can then go and do to make yourself in the position to invest. So, and we are talking specifically about investing in your own property and buying assets. Again, there's lots of other strategies you can do with property if you are a ninja effectively, but not actually in terms of what we are talking about here in buying your first investment property.
Yeah, it's I guess the way I kind of describe it is, consider this the 100-meter sprint, if you will. People who can tick more of the boxes are starting from 10 meters, 20 meters up the track. If you've got nothing, you literally started from the start line. People who can tick these boxes are just a little bit further down the track, have got less distance to run, so they're going to get to the finish line a bit quicker. So it comes back to, what is your objective? How extreme is that objective? It just determines how hard you're going to have to work in the front end to get yourself 10 meters up the track, 20 meters up the track, etc., and so forth.
Absolutely. So I think we've covered enough around the personal circumstances, making sure, and this is always, as personal circumstances, as I mentioned, is a snapshot in time. Your credit report is a snapshot in time. Your income right now could be different to what it might be in 12 months. There's so many things, and this is why it's constantly evolving. And just having a good relationship with your broker to make sure you're updating them of all the different changes that are going on will help with that. So we move on from personal circumstances, and the reason probably this makes the next step will be around the property strategy. So number 3 on our list will be property strategy. And this is how you're going to go about working your plan and your goals based pretty much on your personal circumstances and your goals. And so there's lots of different investing strategies, but obviously we're talking here very specifically around your first one. And, if we just talk at a high level of the different strategies that are available, we'll then maybe just discuss them really. But, you're looking at buy-to-let, sort of just normal single-let occupancy. You've got HMO, which is a house of multiple occupancy. You've got service accommodation or Airbnb or holiday let. You've got commercial investing. You've got property development. And so there's lots of different, there's lots of others as well and more advanced strategies, but just keeping it as simple as possible at the moment. For someone starting out buying their first property, the general advice, and this won't always be the case, again, going back to your personal circumstances, the general advice is start with a buy-to-let, a straightforward buy-to-let, to understand the dynamics of the purchasing and how that strategy works, what it's like to understand the different rights that, going through if you're going to have tenants, understanding the management process, understand working with an agent. Are you going to self-manage? Obviously in Wales, there's the Rent Smart Wales. In England, the renting rights bill is about to be approved and sent through, and we're not quite sure yet when, but that's going to really kick in soon. So there's going to be massive changes on that side as well. So it's just trying to understand what strategies are available to you based on your circumstances. Any thoughts on that?
Yeah, loads of them. Yeah, where to start? So I think tying this back to your personal circumstances and your investment objectives, okay, and tying this back to a lot of the conversations that we have. So now, somebody who's thinking about getting into property has probably had a spark somewhere, has probably knows somebody who's got property, or has seen something online, or perhaps has gone on YouTube and these sorts of things. Okay, so they've got a rough idea, or they're aware of some of these strategies. And very often we end up speaking to people who want to invest in property and will probably chase the higher cash flowing property investments. Okay, so these are things like HMO, SA, service accommodation, commercial. The reason being is there's a lot of rhetoric out there that buy-to-let is dead, that it doesn't work financially for whatever reason, and there is an element of truth to that, as always. And people then think, oh, well, actually, I won't do a single let because it doesn't, it's not generating the figures that I ultimately want. It doesn't get me to my objective fast enough. I'm going to chase these higher cash flowing or higher yielding strategies, such as I say, HMO, SA, and so on and so forth. And that is great in theory. Everything's perfect in theory. The reality is when you want to come and actually do the mortgages, lenders have some hurdles that you have to clear in order to get yourself up into what are perceived to be the higher riskier property occupancy types. Okay, so this isn't a higher risk property, it's a higher risk occupancy type. So the dynamic of putting 4 unrelated people in a property and they're a HMO and make sure they're all happy is quite different to putting a family in a single let who's probably going to stay there for the next 5 years. HMOs turnover far greater than a standard let. If you're going to do a serviced accommodation and you're looking to manage it yourself, the number of turnovers, 3 turnovers a week if it's Airbnb, you might want to do contractors, but still there's an ongoing, it's a very, very different dynamic. And the lenders ultimately want to see that you have experience or exposure to the entry-level stuff, single let, so that you, as I say, understand the dynamic of managing the tenant more than anything else. And then once you've got that experience under your belt, then the door's open to go into the more complicated or the higher risk strategies. So yeah, that's something to bear in mind. You can get there, but there are fewer lenders. You're going to pay higher interest rates. It's going to impact your returns. And you have to question, do you want to run before you can walk?
And this again, so all of this comes down to your personal circumstances. And like you mentioned earlier, your 18-year-old who's had some advice down the pub, I'd question you on that. He probably hasn't been to the pub. He's probably had some advice of someone in a sauna, in a health club. But ultimately, they've had that advice. If you say to yourself, right, I own my own home and I want to go and buy my first I don't want to get into buy-to-let. I'm not going to get enough cash flow. It's not going to get me to my goals as quickly as I'd like. I want to go straight to HMOs. We are not saying that can't be done. What we are saying is it's just going to reduce massively the options available to you from a finance perspective. And so instead of going, if you went as a first-time landlord to the buy-to-let, you'd have access to the majority of lenders. If you say, not all lenders do HMOs. So just by saying I want to do HMOs, you're going to reduce the number of lenders available to you. And then if you say I'm a first-time landlord and I want to do HMO and I don't have any experience in managing HMOs, you're going to reduce those options even further. So what that will mean is that's more in the specialist space, and the interest rate's going to be higher than what it would be somewhere else. So it's just, and then you get to that point and people are then going, well, that doesn't work for me now from a cash flow perspective. So almost always we can finance a deal, and people say, oh, I can't get finance. We can get you finance. It's just whether you will be happy with the rate that we pay, that you're going to pay on it. And that's when then there's a bit of resistance back and forth saying, oh, I can't get a deal. Well, you can get a deal. It's just not at the rate that you want to pay for that deal. So that's the difficulty, isn't it? That people come up against.
100%. Yeah, and when you couple that, it's a great example there. Where you're cutting it down, and the lender pool is small, and we've only considered the property occupancy type, HMO. Then when you couple that with your personal circumstances, which we've just covered, and you're a non-homeowner, you've got no income, again, you're further filtering that quite small pools, and then you can see how now all of a sudden you're dealing with maybe 1-2 lenders, and you're going to attract the rate that comes with that going forward. So all of this forms part of the equation as to how you're going to end up going where you're going. As I say, it's not that you can't do it. Absolutely you can. But buyer beware. Just be aware of what you're walking into it's not quite as straightforward as Dave down the pub or in the sauna is making it out to be.
The other one as well, just reminding me of something then, what also happens is as you go along that journey and we're reducing the number of lenders, and we're ultimately ending up with one or two in some instances for this specific deal and your specific set of criteria. Those are generally specialist lenders who don't have the manpower of the bigger lenders, in which case their processing tends to be a lot slower as well. So there's a lot more back and forth, and they will want to see more information than others because of the nature of it, where, and it being a little bit more niche. And that takes longer as well. So then sometimes you get the pushback around, oh, this is taking forever. Well, it's because it's such a niche proposition and there aren't many lenders. You don't have much choice. And so the people who are offering, they're prepared to offer it to you, but they want to know a little bit more and get some proper understanding around how you're going to keep up with the payments on the loan. Ultimately, that's all they're interested in, is, are you going to pay the interest on this loan, and are we going to get our money back in the future?
Yeah, because they don't want the property, right? Many people they'll repossess it. No lender wants the property. They just want their money back. It's too much hassle. Everybody loses in that equation. So yeah, definitely. So the other thing then, so we've spoken about, you're new into it and considering your strategy on that perspective. The other side of that conversation then is around looking at your overall objectives. Okay. So let's say you've bought your first buy-to-let, okay, but your objective is that I wanted to own 10 properties. Yeah, we've got this number of 10 properties. I wanted to do X, Y, and Z. Actually, depending on the strategy that you choose, or the business model, or whatever you want to word it, the strategy that you choose may actually mean you only need 3 of them to get to that one objective. Depending on what your objective is, you can then, you may find that you need fewer properties to actually do that, depending on the strategies that you pick and choose as well. So whilst we are talking about, there are challenges about getting you as a first-time landlord into some of the more riskier or the more higher cash flowing strategies, bear in mind that, those are legitimately useful to get to the end game.
Yeah, one of the other things to consider really are, I remember having a really good conversation with a client that came to us, is the importance of skill set. So you might be a first-time buyer you might be a first-time landlord, but you've been a letting agent in a HMO letting agent, and you've been managing HMO properties for the last 5 or 6 years, and you can clearly demonstrate that will open up more options to you from a lending perspective, because whilst you don't have your own experience from ownership of HMOs, you've been involved in that process, you fully understand the nuances of how HMOs are run and operated, more lenders will be open to you. So that's around how sometimes you can have more options. The other one, I remember a conversation quite a while ago, and this was more around strategy, on what property strategy to choose. There was a guy who was a project manager. He was working with a number of developers and housing associations, and he was doing massive deals, and managing the whole process. And he said, I've got one rent-to-rent SA, and I want to get another SA. And so we were chatting away, and I said, how are you? How much time have you got on your hands? SA can be time consuming, with the changeovers. He said, oh yeah, this rent-to-rent SA I've got is taking up a fair bit of my time. I said, all right, okay. And what about your job? I'm really busy with my job. I really enjoy what I do. I'm doing these big projects, multi-million-pound deals. I'm very involved in that. I said, right, so you want to buy another serviced accommodation now? The one you've got is already taking up a lot of your time. You're very busy with your work, and now you want to add more onto that. You've got a really well-paid job. What are you trying to achieve here? What are you trying to do? Well, I really want to build my wealth. Okay, so let's take it back a step. You've got enough income for now. You're not looking for more income now. You're happy in your job. So if you're looking about building wealth, why do you think you could do one of these developments on your own? Yeah. Oh yeah, and I could do one of these in my sleep. Right. So why don't you, instead of looking at rent-to-rent SA and buying SAs and creating more headaches for you now, you don't need extra money now. You can play a longer game. So why don't you look at your own development which you might not make anything in the first couple of years, but you might be making in years 3 and 4, 5, you might be making hundreds and hundreds of thousands of pounds in profit. That might be a far more lucrative view than making £400 or £500 a month now from these SAs, which are actually causing you more headaches, in the short term around. So, most people have either time, money, or cash. Sorry, time, skills, or cash. Those are the three things needed to do a property deal. And if you've got, a certain skill set that other people don't have, then you can put that into a deal. Most people have either one or two of those three things. It's very rare that you've got all three, because if you've all got all three, then you're just doing deals on your own and you don't need any finance. You've got all the time, the skills, and the money to do the deals. But in this instance, this guy had the skills. He didn't necessarily have the money, but he could probably, and he had some time that he could put into it. So there's definitely a deal that he could be doing. He could be doing a JV to find the money. He could lend the money. So you just got to understand what your skill sets are. And again, it goes back to the long game. What are you trying to achieve in the long game? And what are your skill sets that would play into that?
Yeah, a really valid point. And I think, with all property, it's quite intense in the front end. Assuming you haven't got a tenant that's causing you loads of issues and so on and so forth, it can be intense during the process as well. But actually, it's quite intense. So I guess the point there is choose your hard, isn't it? It's difficult. It can be difficult. Do you have the capacity to do what it is you intend on doing? So numbers aside, can you actually follow through on something you've started? Because the last thing you want to do is go take on borrowing, which costs money, and then not be able to get that property so it's income generating to a position that it covers itself. Ultimately, it's going to cost you more than you're going to make, and you're on the wrong foot to start off with.
Yeah. And the other thing that people don't consider that much, and that they should give more consideration to, is management. If you're going to build a buy-to-let portfolio or HMO portfolio, are you going to self-manage, or are you going to get an agent in? And obviously that's fine, but you just need to make sure you've got the right people to work with, and you've got a good power team. Who's going to manage the maintenance? Are you going to do that, or are you going to get somebody else, and you're going to have the agent to manage that? So lots of these little things to consider. I know some people who have actually made an active decision to invest away from where they live. So there's a couple of schools of thought. So some people will say, well, I want to invest within a 30-minute drive of where I live, because I can go to my properties, I can do inspections. If there's something goes wrong, I can call by, and that's fine. But other people have made the choice to actively invest in other parts of the country so that they don't get dragged into the maintenance. They have to put systems and processes in place and work with people and their power team in order to manage that process. And it becomes very slick and organized and systemized, so that they aren't dragged into it, because they don't want to spend their time driving back and forth to change light bulbs or to change locks or whatever it may be, So again, these are all of the little considerations that people should be having before they invest.
Absolutely. Could agree more.
Okay, so I think that's probably enough around the strategy and the type of I guess probably that we did touch a little bit on it, but development is another one, isn't it? If you're a first-time developer, you've got no experience, and you just rock up and say to a lender, I want to build 50 houses. I've got the development lender is going to say, well, what experience have you got? Well, I don't have any. And that's going to be a challenge.
I got Lego.
Yeah, exactly. And whereas if you say, well, I found a plot of land and I want to build 2 houses. Okay, that's a slightly different concept. What experience have you got? Well, I don't have experience, but I've got a builder, I've got an architect, I've got a QS, I've got a really solid power team who have all done this before, and they're going to manage it all. Right, let's talk. Or I'm a builder, I've been building houses for the last 20 years. For other people, I want to now do it for myself, and here's my experience on those. Again, so it's just painting a picture for the lender, for them to get comfortable that they are going to get their money back.
Yeah, absolutely. And look, if development is your thing, and there's many reasons why it would be, we've done an episode, we've done quite a deep dive on into development finance and this, how you go from one property to 200 and so on. So yeah, check out that episode. We spent about an hour and a half, I think, unpicking all of that. So yeah, definitely check out now.
Cool. Okay, so let's move on to point number 4, which is probably the last, around the sort of personal circumstances and the setup of the planning process, and that is personally held property versus limited company and sort of taxation. Now, again, probably just a point of note there, we've had a couple of episodes recently with tax accountants, tax advisors and accountants rather. So there's a few episodes, if you just have a look back, that we go into this in a lot more detail. So we don't need to dwell on this now, but just for the purpose of this episode, one of the key considerations that you need to make if you're going to buy your first property is, are you going to be, and this is one of the first questions we would ask you as an advisor, because when you're asking us for, what are the rates going to look like on this specific deal? Are you buying this in a personal name or are you buying it in a limited company? And as mortgage advisors, we aren't qualified to give tax advice. We're not tax advisors, we're not accountants. So you would need to tell us, we can kind of discuss it with you, but we can't give you any advice in that space. You would have to come to us and say, I want to buy it in a personal name and this is why I want to do that. Or I want to buy it in a limited company name and this is why I would want to do that. So a lot of the inquiries that we get in for people who are looking to purchase their first investment, actually we're sending it, that conversation doesn't last that long at the moment if they haven't had that advice, because they need to go away and tell us. Obviously we can have these types of conversations, but it's them coming back and telling us what that would look like.
Yeah, and it goes back to your personal circumstances. So what personally is your set of circumstances, it'll be different to someone else, and that advice will change shape as well, depending on what's appropriate to you. One of the conversations that we do have as well, because it is heavily weighted towards a taxation conversation. It's very topical with everything that's going on in the world right now. I always do mention, though, to people that don't necessarily let the tax tail wag the dog. Reason being, there are other reasons why you would consider a limited company structure over a personal ownership structure outside of the tax conversation. So, we come on to this in a bit as well around inheritance. It's easier to give somebody 10% of a company than it is 10% of a property you 100% own in your personal name. There is limited liabilities that come along with this structure, although that is kind of somewhat nullified by personal guarantees, which we've covered in a separate episode as well. Look at us checking out all the other episodes as well. So there's that. But there are many reasons why you would do that. You may go into property at a later date when you're more experienced. Perhaps you may partner up with somebody as a joint venture. You may want to isolate that into a different company and so on and so forth. So many reasons why you would consider limited company versus personal. Taxation is a huge topic, and as you say, one that you would pick up with your accountant or tax advisor. But as just because it's tax efficient to do it that way doesn't necessarily mean it's the best structure for you in the longer term, and that's why we refer back to your objectives, your personal circumstances, and now you can start to see why this picture is starting to now come together as to this isn't a straightforward yes or no answer. It always depends. That's probably my favorite word. Whenever I speak to people, it depends. I've got a million questions I need to ask you before I can start to steer you down a particular path on where that conversation goes.
And also, I think sometimes people do get a little bit frustrated. They come to you and they want quick answers. And our job, our role effectively is to push back and kind of make you think about these things, because we want to make sure we're helping you and as effectively as possible. Personally, I've been through this myself. I had property I owned property in my personal name with my wife. I owned property in my personal name with my ex-business partner. I had a limited company with my wife. I had a limited company with my ex-business partner. I had another limited company with two other business partners. It became a mess, and I was probably, what we talked about earlier, one of those people who just went a little bit gung-ho and didn't give it enough consideration. So this is me talking from a position of having been there and done it as a property investor, trying to kind of just build a portfolio as quickly as possible and not give it. And some of those changes came in during that time.
One other thing I just want to add on that on that point around the taxation as well, is the advice you're going to receive is based on today's rules. Okay, we have a change of government. Well, we know there's going to be a budget in early November. Those rules are going to change. We've seen a migration from people moving their properties from personal names into limited companies for tax benefits, for tax purposes, legitimately as well. All it takes is for the government to decide to tax limited companies differently for property, which, let's face it, they've done stuff like this in the past, and so on. And then all of a sudden, everybody's going to move from limited companies back to personal names. So that's why I say don't let the tax tail wag the dog, because there are other reasons over and above it, and you won't circumvent tax.
Yeah, and another one is furnished holiday lets, as an example. So furnished holiday lets didn't fall under the banner of Section 24, and you were still able to write off the 100% of the mortgage interest as an expense. And so a lot of people continued to purchase. They either transferred their personally owned properties into and turned them into furnished holiday lets, or they continued to buy those properties in their personal names because of those tax breaks. Now the government's changed those and brought it more in line with Section 24. And now that's a headache that they've got to deal with. And this is where the environment of things change. Okay, so I think we can leave the tax, the personal versus limited company one there. Like I said, we went into it in a fair bit of detail previously. So that's the kind of goals. That's the section one, if you like, of this checklist, around your strategy, your goals, your personal circumstances, and the taxational setup of it. So let's move now on to sort of what we probably section two of the considerations of things to do before you buy your first property, and that's more around the deal analysis. So that's the end of part one of this podcast. Wait out for part two, which will be released next week. Hopefully you've enjoyed the first part, which is all around understanding your objectives, your personal circumstances, and your strategy to buy your first deal. Wait out for part two of this episode, and we'll go into a bit more around deal analysis. See you on the next episode.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.